So on the agenda for today, we will begin with some opening remarks from Joan Laria, who is our CEO here at Convergence. This will segue into a robust panel discussion with our esteemed panelists. And following the panel discussion, we will have a 15-minute open Q&A with the audience, where the audience can get a chance to ask the panelists questions directly. So without further ado, I'd like to invite our CEO, Joan Laria, to give us her welcome remarks. Joan, you have the floor. Welcome.
Thanks, Olive, and hello to everybody. Glad to have you with us today. I'm going to make a brief mention of who Convergence is and make sure that we're all operating with the same definition of blended finance. I would like to frame why it is we're talking about macroeconomics and what the import is for us as practitioners in blended finance, and then we'll open it up to the panel. So first of all, who is Convergence, in case any of you are not familiar with us? We are the global network for blended finance, and we are a membership-based organization. Our members are a part of a global community of institutions and businesses who are interested in driving capital into developing economies. And that includes private investors who are looking to diversify their portfolios and who are operating on commercial terms, and businesses hunting for capital, as well as public agencies and philanthropic foundations who are trying to make their funding go further. So for context, let me just make sure that we're all operating with the same definition of blended finance. So in Convergence's view, blended finance is the strategic use of catalytic capital, which is the kind of funding that might come from a public donor agency or a philanthropic foundation. The use of that kind of capital to increase private sector investment in developing countries toward the achievement of the Sustainable Development Goals. So it's a structuring approach. It's not a philosophy. It allows people handling different types of money with different objectives to be in the same transaction to achieve their own objectives, whether that's financial or social or a blend of the two or environmental. So it's not an investment approach like impact investing. It is a structuring approach. Blended finance transactions typically have a return, a positive return of some sort. Now, who gets the return, how it's allocated, who's taking what risks, that's the science of putting together a blended transaction. A blended transaction ought to have impact because those who are bringing the impact, that catalytic money to the table, are trying to achieve more impact per dollar. And it ought to have leverage. That is, those who are bringing the catalytic money to the table ought to be in the business of making a transaction happen that otherwise would not attract private capital. So that's blended finance. Now, why are we interested in macroeconomics, and why did we think it might be a good idea to bring this discussion together today? Both the macroeconomic situation and the volatility in the situation, that is the degree to which investors think they can make forecasts, both affect the availability of capital and how it flows. So as advocates for blended finance, we want to see blended private capital flowing to and within developing countries toward achievement of the SDGs, because we only have about 8 years left before the stated deadline. But we've been hit by headwinds, right? We've had a pandemic whose economic effects hit all sorts of people in developing economies, particularly very vulnerable people and women in particular. We've had a war in Europe that has sent another shock wave in the form of food insecurity and other effects around the world. We have a climate crisis underway, which was predicted long ago, but is now definitely here. A week ago, a third of Pakistan was underwater, and that's a nation of what, 230 million people. And that's just one example. So we've got all of these shocks. And before that, progress toward the SDGs was mixed and financing was falling short, right? When all of the SDGs were declared, the financing gap per annum, that is the amount of more money that needs to come to the table, was estimated at 2.5 trillion per annum. And now we have countries in financial crisis and with very low fiscal headroom, rising debt servicing costs. So now the OECD's latest global outlook for the financing gap to achieve the SDGs is on the order of $4.2 trillion a year. So we definitely need private sector capital flowing into the equation, and we definitely have headwinds. So the title of this was, what does the macroeconomic situation have, what impacts might it have on blended finance? It's also what answers might the structuring approach that blended finance represent, what answers might it have for addressing this situation and keeping us on track toward the SDGs? So today, joining me, we have some great guests, and please come on camera as I introduce you. Leonce Ndikumana is a distinguished professor of economics at University of Massachusetts Amherst, and he's also the director of the African Development Policy Program at the Political and Economic Research Institute, also at University of Massachusetts. So welcome, Leonce. We also have Neil Gregory, who is a thought leader on private finance for development, and he's also currently a lecturer at the Johns Hopkins School of Advanced International Studies. Neil comes to us after a long career at IFC, where he just retired. Also, we have Matteo Pegon, who is the head of blended finance at IDB Invest, which is the private sector arm of the Inter-American Development Bank Group. And finally, Dr. El Haj Bah, who is the chief policy economist at the African Development Bank Group. So thrilled to have you all with us. And let me just make sure we're all on screen. Looks like we are. Great. I'm going to start out with Leonce as the academic in our group today. Can you please walk us all through, because I'm not a macroeconomist and I forget how all these things connect to each other. So we are all facing, all the economies of the world right now are facing high inflation. Can you walk us through how that differs in various countries? And what are the mechanics again? Remind us how high inflation, interest rates, and exchange rates all connect to each other. Can you walk us through that and also the differential situation that different countries might be in right now?
Okay, thank you very much, and good morning, good afternoon to all of those who are able to attend. A really great audience. So as you correctly stated, everything is connected. It's all everything is impacted by everything, and as you also correctly stated, not all inflation is created equal. Both within a country and across countries, countries experience different drivers of inflation and different patterns of inflation. But generally, what we see is that there are, as we would have expected, factors arising from the supply side have been prominent in recent times. Energy challenges have been an issue, exacerbated by the war in Ukraine. Agriculture shocks. In this case, you have the problem of grain shortage, and countries that are import dependent have been affected severely. We have also now, at least in the US, is very, very clear, a wage productivity push inflation, and that has been keeping the pressure on prices. On the demand side, we have seen the impact of the pandemic stimulus, fiscal expansion in some countries, and also money growth, the standard ones. So, for example, in the US, we are inflation is reaching 5%, which is has been last seen in the 80s. That's quite high. Of course, again, in some countries would kill to get 5% inflation. Some countries are facing double-digit inflation. So in the US, what we see is that inflation is mostly, the momentum is maintained by tight labor markets, which push wages up and puts pressure on inflation. Housing prices, both home owner-occupied houses that have been rising, prices have been rising, but also the rents. And that, as we know, is a big chunk of the consumer basket, which raises prices. And all this create a third important factor, which is elevated inflation expectations. So the public expects high inflation, and then you have high inflation. In African countries and other developing countries, what we have seen is recently a big effect of exogenous supply shocks. I mentioned the war in Iraq. Gas prices have been rising very, very much, and all that creates what we call imported inflation, which trickles into domestic inflation. But of course, that comes to exacerbate domestic pressures arising from the fiscal side and the monetary side. So what the central banks have been doing is to try to put a brake on inflation by raising interest rates and tighten domestic demand. In the US, inflation interest rates have the Fed has been raising interest rates. Now it's about, we expect that the interest rates may reach 3.5% by the end of the year, which is quite high. And in fact, some observers even say that the Fed should be raising interest rate faster and higher. I'm not sure. Because there's a risk that if you raise it too much and too fast, you may drive the economy into a recession, and that's not going to be a good outcome. So now the question is, how does all this affect the financial system? How does it affect interest rates and exchange rates? What we see is that as the interest rates rise, one of the things that's going to happen is that the cost of debt is going to rise. So the debt service rises because of higher interest rates. And that's going to be magnified by the fact that as the US interest rates rise, the value of the dollar rises. So the US dollar appreciates. So countries that have been borrowing in US dollars or any other currencies that whose value is appreciating will see the cost of debt rise. One, because of the high debt. Two, because of the high value of the dollar. So every country will have now to raise more money to pay the same amount of debt. This is a big concern, especially knowing that even before COVID, African countries for sure had seen rising debt, a momentum that has been sustained over the past decade. And because of the need to borrow more money to support the economies, because to minimize the impact of the COVID, we now see even higher levels of debt. So that's going to be troublesome because they're going to be paying back the loans in dollars, which are now more expensive. So that's also.
Can I jump in here and ask you something? Just follow the trail of thought and help us out here. So rising inflation leads to rising interest rates. And this in the US means the value of the dollar rises, which makes debt more difficult to pay back if you're a nation. All this is talking about sovereign debt. So as sovereign debt becomes more difficult to pay, what happens with the private sector?
It's the same. In fact, sovereign debt is typically cheaper in the sense that the interest rates are lower. So private debt is even more expensive because the rates are already higher than sovereign debt. So, and in fact, you raise a very important question because there's a discussion now that countries are trying to find a way to reduce the debt burden through debt restructuring, debt write-offs, and so on. And while there is a little bit of progress on the sovereign debt side, there is not enough progress on the private sector, on the private debt side. So all this is going to really put a brake on economic recovery in developing countries. All the efforts they are doing to stimulate a recovery are going to be dampened by the cost of debt. And this is a concern.
Let me ask you a follow-on question then. So if I am a foreign investor looking at, say, an African market, what happens to my appetite for long exposure? What happens to my appetite for dollar-based exposure? What happens from the foreign investor's point of view? And then if I'm a domestic investor, what do I see? What's changing for me?
I think it's really a challenging situation because the high inflationary environment discourages investment, whether it is foreign investment or domestic investment, because people are concerned about the value of their profits in the future if they're going to be eroded. But also the high cost of the dollar, it discourages domestic investors, because that means that whatever they need to import from abroad is going to be more costly, and that eats up into their profit. For those who have dollars, it's cheaper. It's actually it's cheaper to invest in African countries, because every dollar buys more domestic inputs. But they are worried about the ability to now earn enough profit to repay the loans. You have to always think about, even if you are bringing in your dollars, you have to think about equivalent as if you were borrowing the dollars in the US to invest in Africa. If the cost of inputs and equipment is going to be higher, then that eats up into your profits, and it's going to be harder for you to repay the loan. So it's not a comfortable situation to be in.
So thank you. And I know you have more to say. Hold that thought. I want to move to Neil Gregory and ask you a bit more about that. What's the private sector's reaction, domestic or international, when you are confronted with the factors that Leon's just described, the fiscal tightening, the inflationary and uncertain environment? And secondly, what is it that development finance institutions can do at this to get ahead of whatever that negative reaction is from the private sector? So what's the private sector's response, first of all?
Thanks, Joan. So I think three things that I would want to point to. I think the first is that while investors are going to look beyond a lot of the current supply chain disruptions and current impacts of the war, they are going to look at what this means for medium-term growth prospects for emerging markets. And so I think you've seen that the IMF has downgraded their growth forecast for emerging markets by about a percentage point compared to what they were looking at. A year ago, we were expecting a fairly strong recovery from the pandemic, but now that's looking weaker because of the more difficult macroeconomic situation that Leon's described. So that's going to put a damp on investment appetite in the first place. But then two more specific things which are going to change the way that investors look at the risk and opportunities of investing in emerging markets. Firstly, the fact that developed markets, the policy response is to raise interest rates across the board. And so that's true whether you look at the EU, whether you look at the US. And historically, when the developed markets are raising interest rates, investors tend to pull back from investing in emerging markets. It starts to look more attractive to put your money into the US or into the EU. So rather than the inflation itself necessarily being a problem, it's more the policy response and expecting at least a couple of years of a rising trend in interest rates is going to be a dampener on capital flows into emerging markets. And then as Leon's talked about, you're going to expect particularly the US dollar to continue to strengthen against emerging market currencies. So that's going to depress emerging market returns if you're an investor looking at it from the perspective of investing dollars. So what does that mean for DFIs? I think it means that there's a couple of risk factors that they now need to help to mitigate more than before. Oh, sorry, I forgot to get to my third point. The third point is that the other macroeconomic consequence of the situation that Leon's described is that emerging market debts burdens have increased significantly. I think they've gone up by about 10 percentage points over the last 3 years. And although we're talking there about sovereign debt, that is important for private investors because it means that the government is going to have more difficulty servicing that debt. That means firstly, continued weakness of exchange rates, as we talked about. But secondly, it also means that investors are going to start worrying about government's fiscal capacity and their ability to perform on the things which they need to do, whether it's specific investments they need to make or payments they need to make as part of PPP transactions, or whether it's a broader sense of making complementary investments and delivery of public services. You're going to see a number of governments under fiscal stress, and so that's going to raise concerns about future government performance amongst investors. So for DFIs, I think in order to continue to be able to invest and encourage private investors to invest, they're going to have to think about ways to help to mitigate these risks. And I think that's where blended finance can be particularly helpful. So on the Forex risk, that means looking at structures which mitigate the Forex risk. And also it means looking at structures which bring in more domestic capital, that if you can reduce the amount of foreign currency debt in the financing plan, then you're less exposed to that foreign exchange risk. To the extent you have residual exposure, then it's usually very hard to hedge that risk. So ways of reducing that risk or reducing the premium that people have to pay to hedge against that risk would be very helpful. And then the second area is helping investors address these concerns about the risk of government performance. So that means, I think, a bigger role for various types of guarantees. I mean, private investors can get guarantees, or they can get political risk insurance of various types, but the premiums can be quite expensive, and that can be something which is difficult to make the economics work and putting together a financing plan. So I think there's a role for blended finance in either reducing the cost of these insurance premia, or providing guarantees or some kind of higher risk tranche in the financing plan, which will take some of this risk of government performance away from the private investors. So I think there are ways that we can do this. That there are tools in the blended finance toolkit. I think it's a matter of focusing on these specific risks when structuring transactions.
Thanks, Neil. Yeah, so essentially, it gets more attractive for foreign money, like U.S. investors, to stay home, right? Mm-hmm. Because the interest, the return environment is better, and it's looking relatively more alarming to be in some of these countries. And I think you have a good point that it's not just currency risk, but it's also government performance as a contractual counterparty and as a manager of the national economy. And you talk about blended finance, both for a theme that is foreign exchange risk, and you also talk about focusing more on domestic investors, which I think is very interesting. And some of the structures you've put out there, guarantees, insertion of catalytic money into transactions, buying down the cost of guarantees as well. All of those are very standard structures. So this would not be a new thing for blended finance. So it's good to hear that there are things we've already figured out collectively that could be useful in this scenario. Let me go to Matteo and ask you, Latin America, as far as I understand, had one of the biggest hits of any region from COVID. I think FDI went down by about 45% in 2020. And Latin America generally has had a lot of volatility in its economic history. So knowing that, and hearing from Leonce and Neil, the kind of environment we're in now, what do you think are some of the things that blended finance ideas can address and can't address in the region? I think there are limits, and I think it's good to talk about what it can do, when it can't do. So over to you, Matteo.
Thanks, Joan. Hi, everyone. Greeting from Waterton National Park in Alberta, Canada. It's a little bit chilly, hence the outfit.
The newest branch office of IDB Invest is in Alberta.
Wouldn't that be amazing? To your question, and perhaps starting with the don't, I think it's debatable that blended finance is a great or an optimal crisis management tool. And I'm going to give you an example. So when Hurricane Dorian hit Bahamas in 2020, and we started looking at it from the blended finance perspective, we didn't necessarily look into sort of what could we do to directly alleviate the effect of the hurricane, but rather where could we build more resiliency in the system so that next time a hurricane hit those islands, the economy is more resilient. And in particular, we realized that there was a relatively low amount of physical damage in the water utility sector relative to the total damages, but the result in unavailability of water, the result in terms of economic losses was pretty significant, and therefore you could see that it would make total sense in that case to invest in added resiliency and also think about some sort of insurance scheme to ensure that the utility had readily available resources to reconnect its system once a hurricane strike, because that would have a ripple effect throughout the economy rather than trying to figure out what to do in the instant. And I think you can transpose that to the current crisis, and it's worth remembering that this is a crisis that is slightly different than the other ones, in that when you look at the root cause of the crisis and how it's been impacted the economy, it's as if, we had taken things completely for granted, like, the security of supply chains and the fact that, as long as you go to your cheapest suppliers, you don't have to worry how this is carried from point A to point B. And, something similar can be said on the pandemic. And so thinking of that, and also thinking about the idiosyncrasy of Latin America and the Caribbean, you do have a region that is close to a big consumption hub, which is the United States. And obviously, want to think of the crisis also as an opportunity is, okay, to what extent can Latin America take advantage of the current crisis to sort of build or strengthen its industrial capacity towards markets like the United States. Now, the challenge with Latin America is that, when you look at the structural limitation of the economy, it's an economy that on a macro basis has a fairly low level of productivity, a high level of job informality, and a high level of inequality. And this is probably where blended finance can be a potent instrument, especially trying to target those areas where through blended finance, and either through a demonstration effect or by embedding more resilience in the supply chain, ultimately you can improve the productivity of the country. As a side effect, you can also create formal jobs, and then ultimately you build that extra resilience in the economy, and also you build a more productive economy that can be competitive on the global market.
That's great, Matteo. So first of all, going back to the root cause of crises and not trying to use blended finance to address the immediate need of people for food and shelter, point taken. And secondly, the interesting about the connection with the US economy, and maybe there's an opportunity here if you choose to apply blended finance toward transactions that make a point, right, that demonstrate something that maybe get people on the right track. So you'd have to be strategic. So in your blended finance unit at IDB, I assume you'd be pretty strategic about thinking, is this a transaction that proves a point? Is it a transaction that gets somebody heading in the right direction? I want to ask you a separate question, since I know that IDB Invest has done an awful lot of blended finance for climate. We not only have a macroeconomic crisis or storm upon us, but we also have an ongoing climate crisis. It's bizarre to say ongoing and climate in the same sentence, but it's an ongoing climate crisis. Can you talk to us about the difference about blended finance for one of these issues versus blended finance for the other? Is there an inherent tension between the two?
Well, I like to think that they're intertwined. Think about it, right? When you read about the potential effect of climate change, you read about heightened geopolitical tensions that can lead to disruption of supply chains. So we're in it. It's almost as it's an exercise of what it might look like in the foreseeable future. The other thing is that the increased level of geopolitical tension does have an impact in how we solve the climate crisis. China and the US, decided that they would suspend their bilateral talk on climate, and obviously that has an effect on when the two largest emitter of GHG emission decide that they would not talk to each other on climate, it does have an impact. Hopefully it won't, but one could assume it will. Finally, and I think both Neil and Leonce mentioned that you have countries with limited debt capacity. And that means that, you know, there's less fiscal capacity to tackle the climate crisis and to tackle some of the investments that are required to manage the climate crisis. And so really back to blended finance, and this is really the way we've been using blended finance for climate, actually, when we, and let me give you again an example, perhaps that's clearer. When we look at, say, supporting charging infrastructure for electromobility in a given country. What we're really interested at is that piece of infrastructure in the foreseeable future could be financed without blended finance. Now, that happens at the point where that charging infrastructure is competitive. So it makes sense for entrepreneur to decide to set up those charging infrastructure, and it makes sense for financiers, whether the local or cross-border, to finance that piece of infrastructure. Now, for this to happen, you need that piece of infrastructure to be productive, and then, you know, this is back to my earlier point about really trying to focusing on competitivity. And ironically, in that example, you're not really using blended finance to address the climate externality that is embedded in that charging infrastructure. So you're still valuing the carbon that is being mitigated at zero. Which is probably a good thing, again, if you think about it from a long-term perspective, because ultimately, ideally, and you know, not all investment can work that well, but ideally, you want to focus blended finance on that subset of investments where those investments can be profitable without any sort of long-term cost of carbon, because that will make them more resilient and that would make them less exposed to the global talks on carbon markets.
Fair enough. I want to switch. Thank you, Matteo. I want to switch, take us on a journey around the world next to Africa. El-Haj, can you talk about the specific impacts of this macroeconomic situation we're in right now, this environment we're in, on the countries covered by African Development Bank? And then you've got both sovereign and private sector operations. So given the impacts you're seeing, are there any plans to change, you know, how you deal with sovereigns and how you deal with private investors? So let me just stop there and we can come back to more questions after that, but just lay out for us what's happening in your region.
Thank you very much, and thanks for inviting me. So on the impact, Leonce and Neil has already talked a bit about the impact of the crisis, because we have the high debt level, and today, many African countries are facing a risk, or moderate or high risk of debt distress. What that means? That means they have hard time to borrow in international markets, and even for development finance institutions, sometimes they have hard time to borrow. So there are countries right now, we don't lend them money, because the high level of debt, we don't want to add that. So we just give them grant. And the level of grant, of course, is limited. So level of debt high, you have less investment on critical infrastructure, on critical long-term development projects, because you don't have the money to do it, and you cannot borrow. So the other thing I want to touch on is this high interest rate. You know, Leonce explained, you have high interest rate in the US because they want to combat inflation that have consequences for Africa on the debt and appetite for investment. But also you have high inflation in African countries. And so that means some of the countries, they need to raise also the interest rate so they can combat the inflation. So if they raise interest rate, that means the SMEs or the private sector, so they have less appetite to borrow. You know, you ask about this impact on the domestic private sector. If you have an interest rate of 14% or 20%, right? I was looking at Madagascar the other day, it's like around 20%, okay, to interest rate. So you need to be very, very profitable for you to be able to borrow at that interest rate. So that means most businesses will slow down investment because they cannot. So that's another angle we need to look at. The third angle for us is the impact of the war in Ukraine, because that is causing a shortage of grains. In Africa, we import a lot of wheat and maize from Russia and Ukraine. So that can cause a food crisis if we don't take immediate action. So what at the African Development Bank, what we did is to have a emergency facility for food production. We approved 1.5 billion, so we can lend to countries that can borrow, right? So they can basically provide grains, high yield grains to their farmers so they can produce. So in the next 2 years, we can increase the production of food and lower import. For countries that cannot borrow, we give them some grants in that 1.5 billion package, right? So that is some action we're doing from our sovereign side, right? But as you said, we have both sovereign and non-sovereign operations. So we recognize that, countries have less ability to invest. So then the private sector needs to do more. But given the high risk also, the private sector is limited in what they can do. So we need to bring our instruments so we can incentivize the private sector to invest still, despite the macroeconomic challenges. So we can combine both of these instruments. So in one transaction where, for instance, we can provide a public based guarantee for a private sector transaction so that we can attract the private sector investors. And in the same transaction, we can provide commercial financing through our private sector window also. So we are doing that. We are trying to promote more PPPs so we can address the infrastructure deficit, because for long-term Africa's development, you need to address this infrastructure deficit in terms of transport, especially intra-regional transport, in terms of energy and so on. So that is something we are pushing to public funds for project preparation and also mobilizing and partnering with other institutions so we can do that. And the third impact the third things we are doing is really support countries in the public side on policy, right? Because we need to support them to better manage debt level. So that is something also we are doing. So, yeah.
Thank you very much. It seems that in the African context, we have import-dependent economies, high debt levels. It takes an all approach, kind of an all aspects kind of approach to try to help. And it sounds like that's what the African Development Bank is thinking of, moving some countries to grant status as opposed to borrowing status, doing a lot of public intervention, and also trying to make interventions that eventually help SMEs as well. And it sounds like the role for blended finance that you're sketching out in part is potentially guarantees and other things that help the private sector operators in these countries keep going, right, economically. Tell me a bit about, from your perspective, there's often a debate about whether blended finance, so let me back up a second. Blended finance, according to our data at Convergence, happens most often in lower middle income countries and not the least developed economies. And you could debate whether that's good or bad. In some sense, you could say, well, you might as well find transactions that were almost investable and spend very lightly that catalytic money to get those transactions done in those countries that are easier to do deals in. Or all blended finance should happen in the least developed markets, even if it takes a heavier concentration of the catalytic money to get the private money to show up. So in a crisis like we're in now, or in a macroeconomic instability that we're in now, would you think that blended finance should be working more often in the lower middle income countries or the least developed countries? And after you deal with that, I see that Mateo's got his hand up. So I'll come to you in just a moment, Matteo. So please go ahead, Alhaj.
Yeah, no. So this data is really an observation also we see on the ground, right? But to me, it's not whether we should focus on middle income countries and forgetting low income or the other way around. We should do in all countries. We have two challenges, okay? If you take lower income countries, is that, you know, in your definition, you say you need to have a private sector project, right? So in that, we have challenge to find private sector project that we can do. You know, if you take a small country, you have most of the times the projects are small, right? Even DFIs, it's too small for us, right? So now, for larger projects, it's mostly in the infra side, energy, ports, and so on, right? But these type of projects, that you don't find them every day in a given country, right? There is a limit to what you can do. You can build 1 or 2 power project in a 5 to 10 years in a given country, right? So, so you have the scarcity of this project and lack of project preparation funding. We do that to support the countries. And also the project takes a long time to materialize. They are riskier. So of course, it takes time for us to provide blended finance in those countries. But it is something for us at the bank, we don't have a choice. Our intervention is only on African countries and they are our shareholders also. So we need to do more in those countries. So we try and mobilize concessional financing and provide project preparation, support, handhold the country so we can really develop these projects, so we can provide blended finance.
So that makes sense. I mean, in some cases, there is a natural limit on how much business you can do in an economy, given the size of the economy and the size of the transactions. I hear that. Matteo, let's come back to you. And any of the other panelists who want to jump on each other's points, I welcome that. We have a few minutes before we go to the Q&A with everybody attending. And so please go for it. Matteo, you first.
Thanks, John. Now, I wanted to react on what Neil and Elad were saying on, local currency, local investors versus international investors, because I think it's a very good point, and especially the point that Neil was making on, the opportunity, so to speak, of attracting local investors. And I think this is a very valid point when you think about blended finance. And the interesting bit, if anything, in Latin America and the Caribbean, is that you do see quite a high level of liquidity in local market, and this is generally not a function of how rich or poor the country is. So you have some of the poorest countries in the region that have a fairly high level of liquidity in the market, but the trouble is, either you have regulation that is preventing those pots of money to invest in productive assets that is outside of the realm of blended finance, and that needs policy intervention. But at the same time, there's also capacity and risk misperception that prevent that local funding to flow through productive project. And this is where blended finance is a powerful tool, and I think there's an opportunity there. Now, the challenge is that to achieve that, you need to be able to extend financing on a local currency basis. And I think, if you look at DFIs, they are increasing their local currency capacity. It's obviously not an easy exercise because, it considerably complexifies your operation, but you do see a DFIs building their local treasury capacity. Now, the challenge is also to ensure that the pots of concessional finance, which generally do not come from the DFI own capital, they come from third-party donors such as governments or multilateral fund. You need to ensure that those pots of money can also take local currency risk. And in all fairness, we are seeing this happening. I mean, our 3 largest funders, like the Canadian government, the British government, and the Clean Technology Fund, they've all moved towards allowing us to take some degree of local currency risk, not so much to guarantee local currency risk, even though that could be an approach, but just to invest directly in local currency, because ultimately that's also how you build that additional capacity with local financiers. And very, very quickly, another point on cross-border investor. I think the de-risking narrative totally holds. You just need to be very careful whether that unless you address the root cause of that investment not being to the level of risk appetite of the cross-border investor, you're going to have to keep providing that guarantee for the foreseeable future. Now, I think you can totally do it. It's okay to do it, but you need to be very careful about the level of subsidy you embed in that de-risking instrument, because, you know, blended finance is not a permanent subsidy play. It's supposed to be a temporary subsidy play. And so again, you know, whenever there's a local investor, whenever there's a cross-border investor in the mix and you want to provide blended finance through the risking solution, I think you totally can, but you need to be very careful about that embedded subsidy component.
Thanks, Matteo. I want to come back to Leonce briefly to ask you something to, again, frame everything for us from your professorial perch, if you could. So I would like to know, what I learned from you today is just how closely everything is wired to the US economy eventually, whether, you know, it doesn't matter how far away the country is, you know, what happens in the States has ripple effects. So my question for you was going to be, and I'm going to use the word yield curve, and I'm not sure everybody in the audience knows what I'm talking about, but basically, what's the 10-year forecast in the US for inflation and interest rates? And then I'd love to hear from one of you in the development banks, or Neil having come from IFC. Do we need to really pay attention in blended finance to extending tenors? Is there a long-term investment problem here? Is there a hesitation to go long? So Leonce, what does it look like in the US? If you could paint that picture for us.
Thank you very much for the very interesting question. Before I answer the question, I had to plug in a couple of points which will be discussed. One, I think, is to understand the major differences between today's crisis and the past. I think one of the key differences is that this crisis was different from the previous ones because it was both an economic crisis and a health crisis. And the health component is still lingering now because the COVID is not over yet. But also that's one of the reasons why the labor market is so tight, because some people are still afraid of going to work. There are sectors that have been losing workers and so on, and having trouble for hiring. So they keep jacking up the wages, and that's not helping. The other is a concern on my own, which is again a difference from previous crises in the sense that in African countries, probably other developing countries also same, two things were happening before the crisis. One was this regained optimism about growth and prosperity and so on, which has been dampened. But at the same time, another factor which was rising unemployment of the youth, and that is a big concern for me. So in terms of blended finance, I wonder how it could be used to promote employment and investment, especially among for SMEs, which are, I think, a big source of investment. I know the ADB has instruments that support SMEs through line of credit to banks and so on. Maybe our colleague can talk about that. IFC can be a major player in terms of supporting the private sector, which is the employment creator, because the governments don't have very limited opportunities for creating more jobs. So again, what can DFIs can do to chip in here? In terms of the US and 10-year forecast, I'm more on the optimistic side, that I think inflation is not going to go out of control. It cannot be, because there are things that the central bank has learned from past crises, which has made it even more effective in stabilizing financial markets and managing monetary policy. and regulating the system in general. So better regulation, proactive interventions, to me, makes me confident that the inflation is going to remain controlled, and that the risk of recession is very, very mild. To me, that's my view. Some people think that we may see a recession. Even if there was going to be a recession, it won't be for the next 12 months. And I think it's going to be very mild, even if it happens. That's my view.
Run out and buy my U.S. Treasury bonds now. We are at the moment where we are going to be inviting those of you who have been in listening mode to participate with questions. So please come at us, and Olive, I will ask you to moderate. But I see that El Haj, you have your hand up, and please go ahead with what your thoughts were while we're organizing.
Yeah, no, it was just quickly answer your question and Leon's question. So for long-term investing first, for private sector project, we invest in general up to 15 years. But what we notice for some of the renewable energy project, we need even longer term to make these projects, viable. So we have increased that to sometimes 17 years if the project calls for it. So really there is no issue of long term here. And on Leon's point, the youth unemployment is very important. For us, it's critical in Africa because more than 50% of Africa's population is young. So you need to have these people employed. So we are doing a lot to make sure that youth have the right skills, but we are also promoting entrepreneurship so they can create. Right now, we are developing what we call Youth Entrepreneurship Investment Bank, Entrepreneurship Investment Bank, where it will be a blended finance approach. Basically, it's a platform where you have public money, but also private sector that will support youth entrepreneurs for investment, mentoring, and so on. So it's really a wholesale approach where we can promote that. And financing SMEs is key. We have different instruments, and we continue doing this.
Thank you very much. Other panelist comments before we turn to the audience? Going once, going twice. Olive, what do we have?
Thank you, Joan. I think we will ask the members of the audience to please feel free to raise your hand and ask us any questions that you may have.
And if you don't, I've got lots and lots more, so come at us. And please feel free to, if Olive calls on you, to turn on your microphone and come on live.
I do see a question in the audience from Bernard Ayite from the MasterCard Foundation. Bernard, please feel free to turn your camera on and ask your question.
Hi, good afternoon, everyone. So yeah, my question is, given the rising interest rate, right, especially in African countries like Ghana, is it prudent to use a blended finance arrangement, right, to reduce the interest rate to, let's say, a single digit for MSMEs, especially women-led businesses? Thank you.
Can I jump in here? I'm not a banker, but I think this is a central question. If you look at what's happening now in African economies, most of them are, when you think about the private sector, it's really the small and medium enterprises. That's the bulk of the actors in the economy. And when we think about how to address the issue of unemployment and so on, it's about supporting women and youth entrepreneurship. So how do you do that in the context of high and rising interest rates? I think in addition to think about the interest rate as a barrier to access to credit, we should think about take a comprehensive approach. There are other non-interest rate barriers to access to credit. Let's see how those can also be reduced. The issues of collateral, the issues of even the capacity to package, to prepare a bankable project. How do you support enterprises to be able to put up good bankable projects and to manage them. But at the same time, any ideas about reducing the interest rate through subsidies and guarantees, those would be much appreciated.
I would like to hear from the other three of you who have all been in or are in development banks. You have blended finance principles that you adhere to. Would they suggest to you, or would this situation suggest to you that interest rate intervention is a good idea at this moment? Neil, you want to go first?
I couldn't find the raise your hand button, so I raised my hand the old-fashioned way. So just to give a slightly different perspective on this, yes, interest rates look very high for SME lending. A lot of that is because of high inflation in real terms, that they're much lower. So when you look at the real interest rates, I think the bigger component of what makes lending rates unaffordable to SMEs is the risk premium that banks charge over lending to a large business or lending to governments. So I actually see a bigger role for using blended finance in helping banks bring down that risk premium. And in our experience, that the reason why banks charge such high risk premium to SMEs is due to two things. One is their own lack of experience in lending to this set of borrowers, so they don't not have very much experience in terms of what the risk profile of those borrowers are. And secondly is their ability to get relevant data which to assess the credit risk. So helping banks start lending to underserved categories, whether it be women or youth or other segments of the market that have been underserved, helps them acquire the data they need to make better credit risk decisions, and often allows them to recalibrate their risk perceptions, which leads to enduring reductions in risk premium without needing continued blended finance. So I really see the blended finance role as catalytic in getting banks started in addressing new market segments rather than an ongoing interest rate subsidy.
Thanks, Neil. In the interest of time, I want to move to another question, just so that we have a variety of thoughts coming to the fore. Olive, would you like to direct us?
Yes, we have a question from Aniket. Aniket, if you could unmute yourself and come on camera and ask your question.
Hello, good afternoon, everyone. So my question, actually, I'm from Samrit Blended Finance Facility from India. And my question is, do we have any use cases, for example, wherein the government has actually, or the public money has come into blended finance as capital for further promoting investment in private? Do we have any use cases around the world wherein the government has come in as part of the blended finance project? Thank you.
So the question, in case the audio was not clear, as I understood it, was, can any of us cite transactions where the catalytic money came from the host government?
Yes.
Yeah, I can answer this. I have an example. Actually, this is something we do. Sometimes we structure transactions where we lend to the government so they can use that proceed to set up a facility. For instance, in Ghana, we have what we call GIRSAL. It's for investment risk for the agricultural sector, so risk-based. And we provided them a loan. They're giving this to an entity that is run like as a private sector that is working with the banks, the commercial banks, so they can lend to the agricultural sector. So that's something we're doing. We're doing it something similar in Nigeria for investing in ICT and the creative industries, especially addressing this youth unemployment and entrepreneurship. So this is something we do often.
Does anyone else want to cite a use case? I have seen in our data, by the way, host governments coming forward. Sometimes they do, and I don't have a transaction to share with you, Aniket, but sometimes they do in the form of a grant in kind. So you can imagine a power plant or a water treatment plant whose eventual electricity or water would be too expensive for the ultimate user to use. because it just legitimately costs X to build it, and the economy can't support that number X. And a host government might provide the land free of charge or provide a grant toward the construction. So we see things like that happening. But anybody else want to cite any specific examples? You're welcome to do so.
Maybe very quickly, John, sorry. I mean, that happens all the time. It's just that we don't necessarily capture it, but, you know, government subsidizing the private sector is something that has been happening probably long before DFIs came up with the term blended finance. The only thing perhaps is that I think it's important to distinguish, you know, those interventions where, you know, the end goal is really sort of, you know, allocative purposes and, you know, affordability purposes. So like, I want to make things more affordable for a certain category of the population, and I'm going to redistribute wealth through a subsidy mechanism. Then the alternative, which is probably closer, I guess, to what we do in blended finance, is building efficiency in the markets. Now, the DFI principle allow us to use blended finance for affordability purposes, and it touches a little bit what Neil was saying on the DFI. So we can, in theory, I think the challenge, however, is that we, at least as far as we are concerned in IDB Invest, it's more challenging for us to demonstrate that is more efficient use of public money as opposed to other way of channeling funds. You know, I would almost say that perhaps a government is better placed to, you know, act as the channeler of those resources rather than the DFI that is going to be partnering with a select number of institutions. And if really the end goal is to decrease interest rate for the SME, perhaps the DFI is not the best way forward. However, if, as Neil was pointing it out, if the purpose is to address the risk misperception within the DFI, then blended finance, within the financial institution, then blended finance and the DFI is perhaps a better challenge to extend those funds. And I think there's an important rule there, which is for practitioners, is that whenever you extend a subsidy to a counterpart, I think that the more the ultimate beneficiary of the subsidy is down the line, the riskier it becomes, because you lose track of ultimately who's benefiting from the subsidy. So generally, we tend to be more comfortable in transaction where the direct beneficiary of the subsidy is our counterpart. And so in Neil's example, it's the financial institution that is the beneficiary of the subsidy, even though the long-term goal is that, you know, through this addressed risk misperception, it's going to be cheaper for SMEs to borrow, but the beneficiary of our own intervention is the FI, it's not the SME.
Other comments on that point before we move on? Okay, I wanted to ask a question at this juncture, which is, can you give us, any of you, a couple of examples of industries that investors tend to invest in a recession or in the environment we're in now? Is there a particular sector? Do bonds do well? Do equity investors come to the fore? What kind of patterns do you see among investors, foreign and domestic, in this kind of turbulent environment? Like, tell us the good news. What do people tend to want to do in a situation like this?
I can jump in here. One of the things that happened with the COVID is that we realized that we need to invest in health and health infrastructure in Africa, for instance, manufacturing drugs, because most of the medicines are imported. And, you know, with the stopping of trade, that was a big challenge. So right now, there are a lot of funds looking for projects to invest in that sector. And of course, also with the climate crisis, climate resilience, climate mitigation and adaptation, these are projects that I would say won't be much affected by the current crisis, because it's something we know for the long term we need to deal with.
And Matteo, you talked about climate resilience as an opportunity in this situation as well, right?
Correct. And you know, and let's not forget that climate resilience is not only more resilience to physical risk, it's also more resilience to economic risk. I mean, we tend to over-focus on the physical side of things when we think about climate adaptation, but if you look at the way it's been defined by the UNFCCC, it's a much wider definition. You know, you could almost think, and I know it's a little bit provocative, but you know, in the context of some countries that are really low emitter of GHG emissions, when you invest in climate mitigation in those countries, what you're really doing is allowing them to grow in a world where you can no longer rely on fossil fuel and the like. So, you know, that could almost be construed as adaptation rather than mitigation, because at the end of the day, the impact that those lower tons of carbon are going to have is minor relative to the larger emitters.
So renewables as an import substitution play and as a resilience and adaptation play. Interesting. I see, Neil, that you would like to go next. And we also have a question from the audience from John from Pangea Global. So over to you first, Neil, and then John, if you could get ready to turn your camera on and ask your question after that. Go ahead, Neil.
Thanks. Just to add on this theme of resilience, that I think what's happened both with the pandemic, with the war in Ukraine, with tensions around Taiwan has all pointed to the risks of having supply chains overly concentrated in a few source countries. So I think there are some countries, I wouldn't overstate it and say that all countries can benefit, but there are some countries that can benefit from some diversification of sourcing in global supply chains. And so I think that is going to be one area where some countries, again, not all countries, but some countries will be able to benefit from increased investor interest.
Yeah, I actually was speaking to an Indian entrepreneur yesterday, or an Indian investor yesterday, about a healthcare play in India that is basically a doubling of a supply chain in a sense toward the US market. So that I think is a bright spot. We had a question from John from Pangea Global, if you'd like to come on.
Yes. My video is not allowed, but I'll go ahead with the question verbally. My question concerns investment readiness, particularly for smaller ticket sizes for SMEs, as was highlighted earlier, given the importance of SMEs in terms of the growth of these economies. A common concern is that there aren't enough bankable projects, and that there's a need for investment readiness support to help projects that have great potential, but that aren't quite investment ready. And so my question to the panel is, what can blended finance providers do to help resolve this problem of investment readiness? I see that technical assistance is certainly one solution, but technical assistance most frequently is used post-investment. And so my concern is really pre-investment to get more bankable projects ready for blended finance and impact investment. Thank you.
You know, before I set the question free among the panelists, I would like to point out that one of the archetypes of blended finance we see is to have grant money basically arrive first on a scene and support a transaction to go figure out its pricing, figure out the details of its structure, figuring out which kind of investors it might appeal to and what it needs to do that. And we at Convergence do it in the form of design funding. We have grant windows that do this sort of thing for very specific purposes that we've agreed with our donors. But that is a kind of a classic blended finance approach, is for the catalytic money to show up when there's not a transaction yet and work with somebody on their concept. But over to the panelists, what do you think blended finance has to offer? Any examples or patterns you see in that early stage, helping things get to market, helping them get to bankability, and start anywhere? I think, Neil, you have your hand raised, and anybody who wants to go after, please do.
Yeah, I'm going to voice a slightly different view. I think that many of the programs that DFIs and donors have tried to do to support SMEs have been hugely ineffective. And so I wouldn't encourage us to try and use blended finance to do more of things that haven't worked. What does work in new enterprise creation? What we find works when we look globally is venture capital, where you put in early stage equity and you're accompanying that with very hands-on engagement with the entrepreneurs. So one good model I would point to is IFC's SME venture programs, where we actually use some donor grant money to help us set up first-time fund managers to do early stage venture capital. We've done this in a number of frontier markets in Africa and Asia. And the blended finance can be used to make it economic for a small venture fund to operate in these small markets. Usually it's impossible to cover your operating costs to run a fund at the size that you're talking about in those markets. And secondly, you can use the blended finance to help to both build the capacity of the fund manager so that they can provide better support and advice to the new ventures that are being created, and also provide training and support to the entrepreneurs. But the point about venture capital is that you are not trying to support SMEs, you're trying to create the large firms of tomorrow. You're trying to focus on finding a few winners. And I think we miss that too often when we talk about SMEs, that the real drivers of growth, whether you look at export performance or contribution to employment growth, is actually the larger dynamic productive firms. And venture capital, I think, is a proven technique for supporting the creation of new dynamic productive large firms.
Other views, opposing views?
No, complementary views.
Go for it.
That's a great point. But I want to add the fact that when we think about private sector development, it's not an either or. It's not a small and medium enterprises versus large enterprises. We need both. I think for developing countries, we need to pick up the attention on how do you support small and medium enterprises. And the great question posed by John is that there is, in addition to the supply side, how do you get funders to provide money? There is also the demand side, in which how do you build capacity to actually borrow and utilize the funding. So just as in the large firm side, you can have things like venture capital. How do you work with small entrepreneurs, both those who are already entrepreneurs, but those who can potentially be entrepreneurs, to build the capacity to invest, design projects, and so on? Because many times I get tired when I hear people say, okay, you young people, don't go look for jobs in the government, go become a business entrepreneurs. And who told them to do that? Nobody taught them how to do that. And those things takes skills. It's not just money. People think that if you give me money, I'll become productive, I'll become successful. No, you need to learn how to design a strategy, how to design a project, how to run even if you get the loan, how to actually manage the loan so you're able to repay it. I think investing in building that capacity is actually highly will have high value added. So maybe, I don't know, our colleagues from ADB may have some ideas about whether this is something that they already think about doing or are already doing.
Yeah, I do hear from all of these answers the level of complexity of the kind of simple questions like the one John posed. There's no one silver bullet, right? You have capacity issues, you have mismatch of deal size issues, you have country risk issues that keep some people out of there. There's just so many issues built into the questions that I don't think there's one solid answer for how do you make more projects happen. I think everything all of you are talking about is part of the solution. In the interest of time, I'm going to ask El Haj to go and then Matteo to go, and we might be heading toward the end of our time. So please go ahead, El Haj.
Yeah, no, thanks. Quickly. So for supporting SMEs and entrepreneurship, for me, to help them prepare, it's not about, I wouldn't see this as blended finance. Of course, you need to provide funding to support the intermediaries, like the incubators and the service providers and so on. And for us at the bank, given we do both, so we have a lot of programs really to do this. But I'll say this is public financing, right? And But for blended finance, the type of what Neil was saying is for mostly for infrastructure where we can bring in project preparation money, because if you have, let's say, a 200 million project, you can bring in 2 million to prepare that project, and that could be structured as blended finance transaction later. But for the SME side, it's really supporting the whole ecosystem. As Leon said, that is something critical to help them get ready. Thank you.
Thank you. And Matteo?
Yeah, I think one of the challenges there is, when we look at those different instruments, is we tend to think too much of them in a linear fashion. Whereas, I mean, the reality of it is, especially when you get into something that is untested, is that you yourself as financier don't really know what the risks are, and you discover them along the process. I mean, I can recall a transaction we did in Haiti for microgrid, and it took us a couple of years to close it, and really, we were discovering on the go together with our client to some extent, and so when I think of instrument, I think it's not so much what is the right instrument, but rather ensuring that all the sets of instruments are available throughout the cycle. I would almost argue that one of the mistake that we perhaps do is trying to point at where an instrument should intervene at a particular stage, and by doing that and by imposing that restrictions on the money that we manage, it prevents us from using this money where it's either the more catalytic or it's also the best use of taxpayers' money in terms of efficiency. So I think, as you pointed out, it's really important to whenever you look at those transactions, be as instrument agnostic as possible. I don't think there's any good piece of literature that demonstrate that one instrument is better than the other. I mean, when you start reading about it, you will read everything and its opposite. So clearly there's no consensus there. And from the practitioner standpoint, I can tell you that ultimately the choice of instrument really becomes highly context specific. And, it could be that there's one regulation that prevents me from using a guarantee at that given point in time, or the other way around. In some instances, the only way I can do it is through a guarantee. And to Neil's point, I agree 100%, but I don't know that I would expand this, beyond just venture capital. So I think it's not just venture capital, but it's rather, the idea that you build knowledge within the company and outside the company through the use of blended finance. And obviously the advantage of VC is that you do that very early on, but you can achieve the same objective with long-term debt. And I would argue that where we've seen blended finance being the most efficient is really sort of in building that that knowledge and having that knowledge spill over to other firms in the market.
Thank you all very much. We're actually officially over time. I will make a wild attempt at summarizing and hand over to Olive. So first of all, we're hearing some fairly different situations in the different regions. So not all developing markets are having feeling the effects of the US economy in the same ways, or this situation the same ways. All of these situations need a suite of interventions and a suite of solutions. Blended finance is not a silver bullet. You don't gallop in on the blended finance horse and save the day, but it does have some strength, I think, in sharing of information and knowledge and proving out what the risk actually is in transactions. It can actually be a tool for managing risk in transactions, and it can be possibly a part of a solution to the foreign currency or the domestic currency erosion against the US dollar, which is a big feature in this context. We also heard about some opportunity sets. And so I would like to leave everybody with that thought, that there is opportunity embedded in risk and in trouble. And hopefully the private sector hears that and responds to that, because that's its strength. Olive, over to you.
Thank you, Joan. I would like to thank our very able panelists and our moderator for a lively and engaging discussion. And I would like to thank all of you for making time to join this conversation. And once again, Convergence, we are the global network for blended finance, and we offer data, intelligence, deal flow and market acceleration to our community. And if you would like to learn more about us, you can visit our website at convergence.finance or contact us on any of the email addresses that you see up on the screen. And just thank you so much for taking time to be part of this conversation. And I would like to wish all of you a wonderful day ahead or a wonderful evening.
Thank you very much for the panelists. We really appreciate it.
Thanks, everyone. Bye-bye.
Thank you.